All right, and welcome everyone. We are pleased to welcome Gene Munster. He's a managing partner and co-founder of Loop Ventures. Prior to Loop Ventures, he was a managing director and senior research analyst at Piper Jaffray, where he covered technology companies, including Apple, Amazon, Google, and Facebook. During his 21-year tenure, Mr. Munster received many acknowledgments, including Top Stock Picker from Forbes, Best on the Street from the Wall Street Journal, and was widely recognized for his work on Apple. He holds a bachelor's degree in finance and entrepreneurship from the University of St. Thomas. Gene, thank you so much for being here.
Great to be here. Thank you. And we got a lot to cover. Bad news. I always lead with bad news, culturally lead with bad news. We got 65 slides to get through. The good news, I move at a Tesla ludicrous speed, so we're going to go fast here. Loop is an investment platform, and we are talking today about FAANG valuations, the fracturing of FAANG. We're going to talk a little bit about how important FAANG has been to the broader market, and then we're going to go through each company, talk about the valuation on discounted free cash flow basis, and then separately on the fundamentals. And if I was going to give you one takeaway from today, we want to start with the conclusion is that what has worked in the past won't necessarily work in the future. We believe this fracturing of the market, the fracturing of FAANG between the haves and the have-nots. And so I think that this concept of just simply owning FAANG for the sake of owning FAANG is not the proper investment strategy. I think there's a better way to do it, and we're going to talk about that today. Our mission at Loop is to generate outsized returns to our LPs. We like to say make our LPs a boatload of money. And I want to kind of give you the conclusion. FAANG, the rankings here, we think that Amazon, Google, Apple, these are three companies that you ultimately want to own. And then separately, Netflix and Facebook would be companies that we think over the next 5 years you do not want to own. So let's step back and think about what's happened since the pandemic and where the outperformance has come. It's fascinating. Since the pandemic, the S&P is flat. The NASDAQ is surprisingly up 16%. I would have missed that. And FAANG up 30%. If you're curious at diving a little bit deeper into those numbers, you have Amazon is the leader, up 46%. Apple's up 42%. We have Google up 5%, and then Netflix and Facebook somewhere in between there. But the big leadership has come from Apple and Amazon. And then the question is, how sustainable is this? We look at FAANG's multiple currently, it's 30 times. That's higher than the NASDAQ and the S&P. You know, if you look at a 22 versus a 30, it seems kind of close, but when you look at that on a percentage basis, you know, we're talking about a 30%, 40% premium for FAANG names, which begs the topic about why do we want to own FAANG outright. There's some good historical precedents. For some of you may remember back in the 70s, there was something called the Nifty 50. These were 50 stocks that were thought never to go down, similar to how people think about FAANG today. At the time, the Nifty 50 traded at a 42 multiple. We just talked about FAANG's multiple at 30. And the S&P at the time traded at a 20 multiple. So it was 100% higher. Just mentioned that FAANG is trading at about a 40% premium. This is 100% back in the Nifty 50. There's probably more of you who remember the .com. I was an analyst. I remember it well. At the time, the S&P was trading at about 30 times and the NASDAQ at 175 times. Obviously, because an earnings multiple implies earnings, and there wasn't earnings with these companies. When we think about successful companies and use our methodology on FAANG, it's important to note a distinction about our view of the future of transformative companies. It's just not simply about technology. There's an intersection about humanity that comes into that. Steve Jobs talked about this when he introduced the iPad, that is Apple's intersection. But when you think about companies like Amazon and what they're doing with humans working in fulfillment centers and on the delivery side, when you think about some of the nuances related to how YouTube presents some of its content, all these are more human touches, incredible important piece to companies that are successful. So our methodology will look at each of the FAANG companies. We're going to talk briefly about their DCF and then talk about the fundamentals of each one. This holistic view. I mentioned before kind of this blending of tech and science, and just want to really emphasize that intersection between tech and science creates an opportunity to transformative companies, transform how humans live, work, and play. And that's one of also our guiding principles, is to focus on companies that are transformative. We'll talk about transformative. You'll hear that word many times. So this is our ranking. It's a pretty busy slide here. I'm going to jump to the overall. We saw this earlier, but this basic concept of the line of between FAANG, Amazon, Google, Apple on the top, Facebook, and Netflix on the bottom. And it's, I think, helpful also to start that conversation with a conversation about multiples. It's crazy to think about what Amazon and Netflix, their multiples relative to really the core of FAANG, which is Google, Apple, Facebook. Microsoft also has a similar type. So one just very simple perspective is think about the outliers on the valuation side in FAANG as being Netflix and Amazon, and more or less the other companies, including Microsoft, are more or less have similar multiples that are in parity. So we'll lead with Amazon, and I had Amazon at the top and Google second and Apple third. And I want to just put some other perspective on there. It's close between those three. You can, I would roughly say there are three you want to own. We are ranking them Amazon first here, but it is close. And I think one of the bottom lines with Amazon, this is still an underappreciated market opportunity. And specifically is that e-commerce is still a very small percentage of overall sales. I mean, it's shocking that e-commerce is only 15% of sales in the US. It has spiked more recently to 40% around the pandemic. And then you have the automation side, what's going on with Kiva. This is this kind of virtuous cycle that the company is optimizing. Amazon Go, groceries, Whole Foods, the distribution, Amazon's first party delivery network, all these kind of impacting the speed that we're getting things. And last, I think in terms of Prime and how our deliveries are just getting faster and faster, doubling time. All of these are that infrastructure piece to what Amazon is building. This is the humanity piece. Something that when I was covering Amazon 15 years ago, it was hard to imagine them spending these kind of money. And ultimately, they've done it. It's fun to look at also what's happened with grocery deliveries during the pandemic. It has spiked incredibly high. This is something where it really pushed 5 to 10 years of innovation into just 3 months. We saw the average, about 30% of people in the US were doing grocery delivery. That number jumped to 60% over just 3 months. The risk to Amazon is that some consumers are starting to push back now. This is very similar to what we saw with Walmart in the 80s and 90s as they started to take over some small towns. We're seeing some of this pushback also around some of the boxing and the impact to the environment. And there is regulatory pressure. Of course, Amazon was one of those companies on Capitol Hill more recently. And the multiple, it's a huge multiple. We talked about that 85 times forward numbers. What the impact on that means is that, you know, if there is a big correction in the market, Amazon is more likely to be negatively impacted. And despite that risk to the multiple, I think that we still put this in the ones that need to have, need to own, must to own. And I think at the very core, it's very simple, is that Amazon is still tapping into nascent markets. E-commerce can be much bigger, and what they can do around brick and mortar, taking technology to make shopping in stores when we return to that more efficient, I think is a massive opportunity for the company. If you were going to give me a lot of money, let's say $50 billion or $100 billion and say, go compete against Amazon, it would be really difficult to do that, to procure the land, build the fulfillment centers, hire the people, build the driver network. This is an expensive stock, but likely going to continue to move higher. And we think of this as having 70% upside over the next five years. Next is Google. This is a stable company with core other bets. When we think about a stable company, think about search. I'm going to talk a little bit about search versus jumping into YouTube. Everything we do, revolves around search. Before the pandemic, we were searching for vacations. Now we're searching for new fixtures around our home. Both of those start with search. This is 85% of their business, generates a lot of cash. And this gives them an opportunity to go and build other businesses. They've built YouTube. Today, YouTube is about a $17 billion company, $15 billion in 2019. To give some perspective, that's still relatively small compared to Facebook's $50 billion advertising business and $20 billion from Instagram. But this is an opportunity for them to continue to monetize video. But our real insight around Google isn't about search or YouTube, it's about the other bets. And this is something that most investors are aware of, that the company has other bets, but they really don't have a strong sense about what's in there. And I want to illuminate three of them. One of them is DeepMind. This is a company that helps optimize artificial intelligence, makes it more usable for other companies. At the end of the day, we've heard a lot about artificial intelligence. AI is going to be a fabric of every company, and Google and DeepMind make that more accessible. Another opportunity is with Waymo, which we'll talk more about in a minute here. This is their self-driving car, or Verily in terms of longevity, technologies to help people live longer. So Waymo, fun topic. I believe strongly that humans are fantastic drivers when they're focused, but rarely are humans actually focused. We become more distracted, and in the end, humans should not drive. If you look at what Waymo has done, that is just above and beyond any of the competition in the autonomous space, is the amount of miles that they've driven. Now more than 20 million miles. The next closest is Cruise at around 2 million. That's important because each mile that's driven trains their network, their neural network, their AI to become better and better drivers. So the more miles you drive, the more intelligent you get. And I think that that is a lesson that Google has learned so well with search. The more searches you do, the better they are at delivering search results. So the autonomous mobility opportunity is real with Waymo and can move the needle for Google. We believe that this ultimately could add 20% to Google's top line in the next decade. That's a big number, and ultimately this probably is going to be a standalone company that will get a crazy valuation similar to Tesla at some point. Another important X factor around this is the other bets and kind of other things that the company can do is how much cash they have. I've covered Apple for a long time, and Apple's got a ton of cash. People talk a lot about it. Google actually has more cash than Apple, more than 100 billion in cash. And so they can continue to be aggressive with M&A. I think that's an important X factor here. And the risk to Google is ultimately the biggest risk is regulation. We saw some of that this past week with the Department of Justice and their lawsuit, as in part in terms of how that they are showing their search results, but also how they pay for traffic acquisition. When we think about those dynamics, we think that it is ultimately this antitrust, and this might be the showstopper comment of the entire morning, is that Google may be a net beneficiary of some of these antitrust. And if I may, they can ultimately, if the government does not allow them to pay for traffic, they pay Apple and Firefox and other people for traffic. If they feel that that's anti-competitive, using their balance sheet to push out competition, we have seen before when Google is not the default in browsers, that consumers simply switch to Google. So what that means is that if Google is saves some money ultimately, they'll get their customers eventually, save some money on traffic acquisition. But that doesn't change the reason why this is on the regulatory piece is on the risk slide, is because regulatory equates uncertainty. Uncertainty is usually a negative impact to the multiple. And I think that's one of the reasons why Google's shares have not performed as well over the last few months, is that regulatory pressure. And Google's multiple pretty much in line with the rest of FAANG, not a lot to say here. But when we put it all together, we think that over the next 5 years, this has about 50% upside. Next is Apple, virtuous cycle of hardware and services. When we think about this virtuous cycle, it obviously starts with the iPhone. This is just over half of their business. And I would think about the Apple story as building blocks on top of each other. The first block is the iPhone 12 and 5G. 5G gets a lot of hype. I stress the word hype, is that these carriers are misrepresenting what the 5G experience is, the speed that you're getting. We've studied this, and ultimately is that the average consumer experience is not going to be that fast over the next year. It's called low band 5G. Call it a 30–40% improvement in the speed of your phone. We believe in a year plus, we're going to get to mid-band, which is going to be about a 4x improvement, and then eventually high band 5G, which will be about a 10x increase in the speed. So 5G will live up to the hype, but I just want to make it clear that we think 5G is a long-term benefit to Apple, a great play on Apple's a great way to invest in 5G. But over the near term, the next year, it's still going to be not about 5G. It's about this base of old iPhone owners. And we go and measure the base of iPhone owners that have phones that are 3 years old or older. And that base has increased by 40% in the past 2 years. In other words, they have this massive tail of just simply people with old phones. We think they're going to be upgrading not because of 5G, but just because they need a new phone. And early indications are that this is off to a good start. But beyond the iPhone and the 5G cycle, which should last a few years in aggregate, the 5G cycle, I think the more powerful part of the story is what they're doing around services today. It's a high margin business. People have enumerated that. I'm not going to tell you probably more than you already know that this is 20% of their revenue growing at 15% higher than their overall growth rate and about twice their profitability of the hardware business. But they're being more aggressive recently in bundling services. And most recently, they announced something called Apple One. And the simple math is this is the first time the company is bundling things like music or iCloud, bundling their Apple TV Plus or Apple News, different combinations for family plans or individuals. But this bundling is something that Apple is masterful at, which is the subtle upsell. In the end, the consumer wins. In the end, Apple wins too, because they're able to upsell. And to put some context on this, the average bundle, the average subscriber of a service, an Apple service, before the Apple bundles were announced was about $8 to $9 per month. The new bundles start at $14 a month. So each person that would incrementally switch from an individual to a bundle plan, that is additional revenue to Apple. The part that's even more exciting for me around services and bundling is what Apple can do around bundling hardware into a service. And this is something that is probably 3+ years away, but we believe is on the roadmap. This is not consensus thinking. But Apple is in a unique position, the only company in the world that can really take hardware and software and make it easy. They're the only company in the world that can sell you in an effective way. Think of it as a bundled hardware software plan. You pay Apple a certain amount per month. You get a new phone every 2 years. You get a new computer every 3 years. You get all of your service taken care of. This is something that, as I mentioned, only Apple can do. And they've been long criticized for having a hardware part of their business with their multiple. But I believe that as they advance to more hardware as a service, that investors will re-rate Apple's multiple to higher than the typical FAANG multiple, because they realize that this now hardware business has a lot of predictability. And I would, if you want to experiment with this, just think about more people working at home, learning from home, and think about how Apple's products are performing and holding up. They tend to do better. Consumers win with that simplicity, and Apple has an opportunity to take advantage of that. This is probably the biggest lever in Apple's multiple over the next several years, if they do in fact come out with a hardware services bundle. The other factors that allow Apple to be a transformative company is effectively their other bets. They don't call it that. But at the top of it is augmented reality. This is the ability to take the real world and either through your phone or through some form of glasses and augment that and basically layer on top of digital assets. So for example, if I'm walking down the street and I've met you before, and it may tell me your name, if I'm wearing glasses, it will remind me your name. Or if I'm looking at a street, it may point out which of the cars pulling up is my Uber. Or you look at a building and it may tell you this is your final destination. You look at the sky, it will give you the weather. There's a massive opportunity around augmented reality. Most investors don't really believe it's going to be that big. We're believers in it. And Apple is one of 2 companies, along with Facebook, that I think will be most beneficiary. Another is just on health and wellness. Wearables, Apple Watch has been a critical factor to this. Many of you count your steps every day, close those rings, and they have an opportunity to make those products even more health enriching. and also take some of that technology and move it to other products. For example, AirPods could use biomarkers. Back to our 8th grade biology class here, our inner ear has slightly thinner skin that allows you to pick up things like blood pressure. Perhaps they have patents on this, perhaps they integrate blood pressure monitoring into AirPods so that many people keep those in for hours per day. And then around autonomy, they've got some of the top talent in the world in AI. What are they going to do around AI and autonomy? That is an opportunity that's not currently reflected. The risks, Apple has the same regulatory risks that some of the other big tech companies, are not as much as Google and Facebook, but does have regulatory challenges. And one that was posed more recently by the Wall Street Journal is, what if Google was going to be limited at how much Google can pay Apple for placement of Google search in Safari? And the Wall Street Journal, or the FTC, estimates that is about 15% of Apple's income. I think the number might be slightly less, but it's in that ballpark. And if there's any sort of moderation to that, that could be a negative. The reason why it doesn't change our view is I think the probability that something happens is very low on that. And so yes, it is on the risk table, but I think it is a low risk ultimately. And Apple's multiple has seen this resurgence in the past couple of years as investors, one, value their services business at a higher rate, and second is start to better understand that hardware isn't necessarily a bad thing, that the outcomes of what happened with Nokia and RIM aren't necessarily going to be the future of what's going to happen with Apple. And this combination of hardware and software and services is actually a powerful positive for the story. We think the multiple can continue to go higher, especially as they start to progress towards getting into hardware as a service. So when we put it all together, we think that Apple has about close to a similar upside of Google over the next 5 years at about 45%. All of those great names to own. Now, we draw the line in the sand. We fracture FAANG here, and now we start talking about the companies that will be more challenged. One, the first is Netflix, and the bottom line is there's limited new growth opportunities. Earlier, I mentioned transformative and that importance of that word. That's important, companies that are transformative, because those are the companies that investors value higher. They're the ones that get the big multiples. That's why Netflix has had a great multiple over the last 5 years, is they have been a transformative company, taking DVD to online. So they still have, and they've deserved that higher multiple. But the question isn't what's happened in the past. It's about what will happen in the future. And so it's fair to start with what their game plan is effectively to continue down their exact path. It's not about transformation. It's about optimizing what they have. A great business, to be clear, but this is not something that I think deserves to be at the top of the investing list. And you look at their growth opportunities, or at least the growth opportunities. International is one of the largest opportunities. They see that generally view that that's underpenetrated and a massive opportunity. But again, it begs the question. We see minimal expansion outside of their core business. And so when we think about those risks related to that, outside of that just simple guiding principle, is this is not a transformative company in the next 5 years. As we think about some of those risks, one has to do with what can happen around pricing and competition. Typical consumer has 4 of these services. We don't think that that's going to change. That is just the reality. It might even go up. But as more competition comes in, I think it gets continually more difficult to keep pricing higher. Another X factor is some of the momentum in the business, and I credit Netflix for being clear about this with investors. But the surge that they've had in growth throughout the pandemic undoubtedly will start to return to a more normal level. We saw that in the guidance for the December quarter, where they were actually guiding the net subs to be down year over year. And so I think that when, again, coming back to the multiple and getting investors excited, when you start talking about down year over year, it's more difficult to demand that higher multiple that they already have. And then the last piece is around content spending. is this is what's made Netflix great. It's not just online video, but their content strategy was brilliant. But the amount that will be needed to continue that's a hit-driven business. And sometimes it's hard to manufacture hits. And when you put it together and you look at Netflix's multiple, which is about 2x higher than Microsoft and Google, Apple, and Facebook, it seems like it should be below the line when it comes to top performing. We do have it here as a 35% upside, which is still a solid upside of the next 5 years. But we do think that it poses more risk. That is a more risky number versus the companies at the top of the fold. And last is Facebook. Facebook is, it's important for me to mention at the top, is I have issues about what Facebook has done to the world. It's important that I mention that. I don't think the world is a better place because of Facebook. I also want to be judicious and set aside that bias and just think about the core business. And when I think about the core business, it is under some of those same realities that this is not a transformative company. And it really comes down to the ability to innovate and get investors excited. And so what has been working for Facebook, in fairness, it's been Instagram. That is probably about half of the company's revenue today. It's been growing fast, but hard to see that speed of growth start to continue. And when we think about some of the risks, this risk around innovation was highlighted in July on Capitol Hill. Facebook's business model is typically either to identify a competitor and acquire them like they did with Instagram, or copy them like they did with stories against Snapchat. And so to the extent that there's regulation that makes it more difficult, and that's the conversation, for them to acquire competitors or to copy competitors, that would make it difficult for them to capture that kind of next exciting thing, that next Instagram, if you will. If Facebook did not capture Instagram, it would be a very different story today. And that's an important part of social, is that people's kind of their preferences change, and you have to always be evolving to capture that. So when we put that all together, it creates a level of uncertainty, which is negative for the multiple. And then separately is that lack of really compelling innovation. There is one piece that I mentioned earlier too, that Facebook is doing a lot of innovation on. It's very small today, and it's around augmented and virtual reality. And so I think that is one X factor that could get us to be more optimistic as we see their efforts evolve. They are the only company that has said they will have glasses, likely 5 years away, augmented reality glasses. And so that could be the next platform about how humans interact, is this augmented reality and virtual reality. And Facebook will likely have a seat at the table. So I'm going to wrap it up here. If we look at overall FAANG today, that there will be a fracturing. On the top, we like Amazon, Apple, and Google. On the bottom, we think that there's better places to be than Netflix and Facebook. And I'm going to wrap it up. There might be time for one question.
All right. Thank you so much, Gene. We do have about 2 minutes here. We had a couple of people inquiring. They're asking about, do you see NVIDIA as a possible future Facebook and Alibaba as a possible future Amazon, as some people are forecasting?
So absolutely, on the Alibaba piece, it is a future Amazon. I think they are closely following, replicating what Amazon's doing. And then second, in terms of NVIDIA and ultimately where this company can be, I don't view it as the next Facebook. I view it as really the next, the hardware piece, the silicon piece of delivering everything from artificial intelligence to autonomous systems to gaming. I mean, they are the backbone. It's an expensive story, but this is I'm favorable on NVIDIA longer term, because I think companies like Intel are in a really tough spot, and NVIDIA is going to be a beneficiary over in the next 5-10 years.
All right, excellent. Thank you. Another viewer, one of our international viewers writes in, if you have any thoughts on uh, ticker MELE
MELE,
or MELI,
MELI,
I'm sorry,
Mercado
MELI.
Libre. I know Mercado Libre well. Great business. Yeah, I do have thoughts. Well-run operation. Amazon is going to have difficulty in Latin America. They have had difficulty, but this company is going to just ride what still is nascent, even more nascent e-commerce in Latin America, and just a great story to own for the long term. And the way we kind of think about the progression is the first wave of e-commerce came in the US, the second was China, the third wave was Latin America, and I think there's still a great opportunity with Mercado Libre there. And you're probably going to see a fourth wave around Africa, and there's a couple companies there that are have opportunities as well.
All right, perfect. And just to wrap us up, one last question here. One viewer was wondering do you consider Tesla a buy or a sell?
If it's the next 6 months, I would sell it. If it's a 5-year window, I would buy more. And I don't mean to give a mixed message. It's impossible to predict this stock month to month, but what they're doing longer term is significant around not only how I think that they can box out traditional automotive companies and have an outsized market share of the car market a decade from now, but also how they're applying their technologies today into new markets, whether it's HVAC, whether it's insurance, battery and storage, autonomy. They have an opportunity to really expand their addressable market. So in the end, this should be much bigger than a $400 billion company.
All right, perfect, Gene. Thank you so much for being here.
Thank you.